I think the Fed nonsense of dual mandates is completely worthless right now because this is the World Series of macro relative to it. The metals are telling me the market's either going to go blow off in a bullish parabolic move or completely implode.
Silver ETF volume on par with SPY ETF. Like, that's just absurd to think about when you compare the two market sizes, trillions to billions. So clearly we're at some sort of mania. We're seeing the good aspects of run it hot thus far in the market where, retail can go speculate on metals and everything goes up in a straight line. There's no downside vol. The stocks are at all-time highs, but there's a really bad side of run it hot too, which is...
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. All right, everybody, welcome back to another Roundup edition of Forward Guidance. We're recording here Thursday, January 29th, the day after the Fed meeting. What I felt like was one of the most boring Fed meetings in a long time. Maybe just because the first third of the press conference was reporters trying to get gossip on what Powell's going to do and the whole fight with Trump and all that, and he was just stonewalling them, generational stonewalling. And that was the third of the press conference, and pretty quiet. Didn't cut rates, which was what expected. Didn't really give a whole lot in terms of anything. So, sleepy week.
Before we get into that, can we make a comment on Felix's flow here? Look at that hair. Did you get a haircut?
Fresh haircut. I got a haircut yesterday. Thanks for noticing.
It's like John Stamos hair. Look at that flow. Yeah. Jesus.
You'll notice I had to wear a hat last week because I was getting really embarrassed about my hair situation, and now it's a bit better.
Hey, at least you got some. Dude, what happened to the Matisse paintings too? You got there's no Matisse.
They're in a bathroom now. Yeah, slowly. I actually got a comment about. I recorded an interview earlier this week, and somebody was like, "The room's nicely coming along, Felix." And it's just once a month I'll add one more new thing, and I'm just the laziest person of all time.
Classic.
It looks
dude.
Great.
Yeah, exactly. Yeah, we're getting there. Yeah, what was your guys' read of the Fed meeting? I don't know. Seems sleepy. Quinn, you put out a tweet. I think that you thought it was dovish.
Yeah, just marginally. I mean, I had the same views going in. I was like, I don't know really how they would surprise in either direction, but particularly it wouldn't be hawkish necessarily. He was just avoiding conflict, and I thought it was interesting that he sort of emphasized in some points the inflation expectations falling and the sort of healthy pass through of tariffs or as they expect, tariffs to be worked through as we progress through the year. So it's hard. I mean, we'll see what happens March, April. The Waller dissent was, interesting to keep his name in the ring of potential Fed governors. But other than that, yeah, there was no dot plot, and we need more data. But I still stand by the belief that Feb and March, the next two inflation prints should show continued dampening, and the labor market just sucks, and there's no really signs of it improving. So I lean towards more cuts than the market has priced in at the moment. Not that it's equities are priced for perfection, so I don't know if it matters that much for them, but that's my view on that.
The Waller one was funny, the dissent. Check out what happened to his odds for next Fed chair. You can just see it's just just pure signaling. It's just dissent, and then now your odds rise, and it really tells you about the state of things right now.
I mean, the labor market, if they believe those numbers, it's with the revisions, it's a negative labor market. So I do think there's a case to be made for cutting. And if you look at the inflation data, the second that Powell turned most hawkish in October was when inflation peaked, and it's been sort of coming down, even outside of just if you believe the BLS data is rigged. A lot of other indicators even from some of the regional feds data themselves show inflation coming down. So I do think there's a reasonable case. I don't know if there's a case for 150 bips maybe, or like if that's what Moran's still are calling for. I don't know his latest views, but I do think there's a case to be made.
I think this is all shenanigans relative to this giant generational short squeeze on metals, which Powell commented, I'm not really concerned about the precious metals move, which is like, how? How are you not concerned that your sacred institution's footing is getting pulled out from under you? Like, to me, this metals squeeze is like
Insane.
way bigger geopolitical issue where you're calling BS on what is reserve collateral? What is it? And then on top of that, what I've been thinking about is clearly Bitcoin. We didn't talk much about Bitcoin. It's completely detached from any other risk asset. And this is my read is just a giant, it's a G2 world. China's pressing us on backing their currency with gold and metals and silver. And I don't know if they're doing it overtly, but there's clear mysterious forces selling, and the incentive to hold Bitcoin is dropping relative to other assets. And I think that's the big game here, where I think the Fed nonsense of dual mandates is completely worthless right now, because this is the World Series of macro relative to it. And it's like, it's fun to talk about the dual mandates, but like when something goes parabolic, when things start going parabolic like this, there's something happening globally that is so different. It's so outside any sort of norm that they should be addressing it rather than saying, I'm not too worried about it.
I couldn't agree more. Like, and honestly, I had that feeling too while listening to the press conference. I was like, man, this just feels so irrelevant to everything that's going on right now. And even like in the press conferences, the only interesting things that they could talk about, Powell just didn't have an answer for. They're like, what are your thoughts on what's happening with the dollar? And they're like, well, we don't comment on the dollar. Like, cool. Well, why am I listening to you right now? And then they're like, what do you think's going on with metals? We don't talk about that. It's just like it's becoming. It feels almost like tying in this whole fourth turning thing, this semantics press conference thing. I feel like the jig is up a little bit in terms of like what's meaningful versus what's actually moving right now in the world.
Yeah, it's like it's sort of the drift of the institution where one, he's just trying to not say anything that like ruffles in any direction. I mean, at the same time, they can't really say like he couldn't come out and say, yeah, actually I'm fucking scared shitless because that means crisis is here and we've completely lost control. I mean, like this game of central banking has always been about lying to smooth over. They can't speak the truth. It's just they just can't. So
and then
I
only
wouldn't read
sources
too much into it.
Yeah, the only source of truth are like stuff like metals right now, and that's where it's really starting to show. I might just pull up a couple charts here to contextualize, but this is commodities month to date, and you can just see how bonkers this short squeeze has been, and just this move. I mean, it's a short squeeze. There's also a lot of other things. Like there's a lot of inflows coming in from China. I think it is really much like ground zero. This is an interesting tweet actually from Eric Balchunas or Balchunas. I don't know how to pronounce his last name, but he's at Bloomberg. Great guy. China has only one silver fund, and the demand is so rampant it had to shut off subscriptions. So now it's at a 42% premium. And this was just mind blowing to me as a signal, because I've had this feeling that a lot of the metals move is, I think it's somewhat correlated to what's going on in the U.S., but it's also this geopolitical situation, and I think the marginal buyer is China. And so to see this basically this fund that's up on a 42% premium right now is just mind blowing to me. It reminded me a lot of the Grayscale trade for Bitcoin in 2020, 2021, where there's just so much demand and no easy ways to access it that people were willing to, buy 30%, 40% premiums hand over fist. And I think this is just a huge signal of what's going on here.
Go to slide 36 and 37 quick. I have two other charts that are pretty wild. This one, silver ETF volume on par with SPY ETF. Like That's just absurd to think about when you compare the two market sizes, trillions to billions. So clearly, we're at some sort of mania. I after our recording last week, I kind of reflected and was like, we just closed this thing talking about the periodic table, and I started de-risking. And then Tyler's video over the weekend. So I was out on Monday thinking that's the top, but then I was like, went to bed Monday. I was like, or Tuesday or whatever it was, where every single person on Twitter was calling the top, and I was like,
Yeah.
that's not really how tops are made.
It's
So
so
like,
Yeah,
confusing.
exactly.
Yeah.
so I was
Well,
like, maybe
you
I'm
know,
selling too early.
I go back on this. I even thought I top ticked it with my that dance thing Twitter posted on Twitter of
Yeah. Which is
um,
awesome.
but what's fascinating is if you think about this from like a macro game, there's 40 years of petrodollar recycling and export dollar recycling that went into like bonds and treasuries. And if there is a crisis of like what is debt, what is a bond, then this thing could go on way longer than we think. I mean, granted,
100%.
you have insane vol, it could pull back, but when you think about the real bubble is the bond market. That has been in a secular, like everyone's tried to short it. We're diluting the hell out of the currency, and no one's called BS on it because all of our institutions are basically like mandated to funnel money back into the bond market. But now our biggest trade partners are not recycling that money into the bond market.
Mm-hmm.
And, you know, we could see something completely wonky because boomers don't even, I mean, like, I have to say, like, boomers just took this stuff all for granted for years and years and years. And I don't even think they realize what's going on. Like, there's very little bond volatility. There's not, but on a relative basis, like this can spiral.
I mean,
And
check this chart that validates what you're saying. This is stocks as share of financial assets, and you can
yeah, it's
see
why
anybody
America.
owns financial assets, but they don't own gold. Like
Yeah.
this is the whole thing we were talking about last week about how positioning was very overweight, and I think it keeps whipsawing in both directions. The positioning resets, but like we said, the fundamental story is so absurd when you look at a chart like this of just how much runway there is, and you just need to manage your position.
I'm all bought in. I've been really bullish gold since late 2022. Is like one of my first Substack articles I wrote, and I continue to believe in it secularly. I don't think we're done.
Mm-hmm.
I do struggle with these statistics. Like these things don't go up in a straight line, and if you do believe that thesis about gold sort of becoming this alternative reserve, I mean, you shouldn't really have to own gold. It's like it's a currency as I view it. But the thing that's so interesting to me is gold volatility is at the same level. It's only reached twice in the last 30 years. 2008 and 2020. Like the two
Volatility cannot
largest
be transmuted. You stifle the
Mm-hmm.
bond market volatility. It finds its way. It finds its way.
But those are generational crises that the volatility is matching. And so I'm just super interested in, like, you can only read through that data point into its effects on other asset classes so much, right? Because like, everything, history rhymes, but never repeats. So it can be different. But I look at that and it's like, yeah, it's like kind of crisis levels for some parts of the market, but there's other parts that aren't. But there's just interesting extrapolations because, like, if you bought, say, oil the last two times gold fall spiked to this level, you made a boatload of money in a few years. If you bought Bitcoin every time gold vol spiked to these levels, you made a boatload of money in a year's time. Copper, like, it's just throwing off all historical correlations. Maybe we don't know how the next 6 to 12 plays out, but
Or
there's
it
a
could be
lot
the
of just different
canary in the coal mine.
regimes. Yeah, it's just a different secular inflation type of regime that we're definitely going to have these rolling commodity bubbles for multiple years. And so I've been white knuckling the metals trade for a number of months and kind of happy to be done with, like, out of it for now. And maybe I have to get back in next week. And this is like, I sold too early, but I'm sort of looking elsewhere. And obviously oil's run a bit, there's probably some geopolitical premium around the Iran stuff. But definitely I think the commodities area is where time is best spent.
If you're thinking about buying crypto but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. Yeah, I think the way to think about it is the distinction between, the rare earths and precious metals versus cyclical commodity upside. Like, that's where I think there's still quite a bit of opportunity. This is actually a good tweet I saw this week about, I think one boring but underrated reason behind the weakness in the dollar and strength in metals and international stocks is that we're in the middle of a cyclical reacceleration. So I think this is something that, as all the other components we talked about, are all kind of coming together right now. But I think this cyclical reacceleration globally is in its early stages, and I think there's a lot more room. So, things like copper, like oil, cyclicals, I think have more room versus just how technically rich some of these precious metals are right now and rare earth metals. But I'm curious how you guys think about balancing those two components.
Yeah, I agree. My personal take is that gold is front running the pending liquidity injections effectively. I mean, as Tyler said, when you suppress bond yields as they've been doing, this is what you get. And the Fed continues to favor this balance sheet accommodation policy over helping front end the real economy. Because when they announce, the RMP and QE, like balance sheet expansion, I'll call it, restarting, but refuse to cut rates, that's just a continuation of their balance sheet accommodation at the expense of front end borrowers. And that's why I actually think you're seeing a little bit of a pullback in small caps versus big tech, because the signs are pointing towards just continued manipulation of yields rather than kind of letting things price fairly and the yield curve steepen to where fair value is. And so I do think, though, there's going to come a point this year where Trump's polling numbers aren't where they need to be to have any odds of success. And that's going to ring a more and more desperate tone in terms of policy measures, i.e. stimulus, that's going to have to continue to get rolled out to try and buy votes. And I think we're seeing the good aspects of run it hot thus far in the market, where, retail can go speculate on metals and everything goes up in a straight line. There's no downside vol. Stocks are at all-time highs, everything you buy. But there's a really bad side of run it hot too, which is when they start chasing the long end around like a dog on a leash, and inflation comes back and stocks are at 20 plus PEs that don't have any upside. And so their policies are just sort of negative for multiples. So I do think, bond vigilantes are nowhere to be found after 4 years of consolidation since 2021, 22. But that game's not over. Like, you can't just keep igniting this accelerant fire without yields being priced. Like, if nominal GDP gets to 7% this year or something, like, you'll see it in the bond market.
Yeah, I'm with you. One of the biggest, we are seeing a massive rotation in capital on a macro basis. Like, if you look at EEM, if you look at Brazil, even Brazil had a massive breakout relative to the S&P. You look pretty much at the Dow transports, But mainly what I think it's driven from is, you go to slide 45. This is the software ETF relative to the SPY. And this could be telling us a couple things, which is, okay, maybe we're heading into a secularly inflationary environment, and that's bad for software multiples. Or it could also be telling us we're heading into a massive productivity boom where Claude and AI are actually decimating software companies. And one of we're really at a bipolar distribution, because we could see the metals are telling me the market's either going to go blow off in a bullish parabolic move or completely implode. It's like the distributions on what's going on here I think it's the end game of what diversification has done for about 40 years, which is, you can't diversify. There's winners and losers eventually. And I think that's what's sort of going on here is, you're all this money passively piled into software for what, 15 years. And now it's coming out like lightning fast and moving into real things like,
Yeah.
yeah,
Here's another one to add on to that from earnings this week of these software companies. They're not being
yeah,
treated very nicely this week. It's like it's insane.
no,
And I think you're right. Like I think there's a lot of what you talked about there, but then also this, when it's so fascinating to contrast, suddenly we just have, there's zero marginal cost for software now to create it. At the same time that you have all these metals surging, it's like everybody's trying to reach for something scarce because they just suddenly realize that the marginal software engineer is not a scarce asset anymore. So suddenly all these software companies are no longer scarce, and it's just like it's a complete mindfuck. And it's very interesting to look at that huge rotation in the market that you're talking about. Everybody's just trying to grab for something real and scarce right now.
scarce.
Scarce,
But
scarce.
you know what
I don't even
this
know what
reminds me of? I said this on a different podcast, if people actually listen to me, but Steve Bannon talks about flooding the zone with shit, which is like, uh, you basically like create so much supply that you don't know what's real. And, one of the things that killed mainstream media is the supply of podcasts and better content. So like, if you think about it similarly, the barrier to access to creating software just went to zero, just like
Yeah.
the barrier of access to creating, media went to zero. And clowns like us can now be on podcasts. And theoretically,
Yeah.
we're better experts than some 22-year-old NYU kid that has no idea what he's talking about writing. It's why media sucks now. It's because no one's actually, the mainstream media, no one's actually an expert. They were just recanting from experts. Now
Yeah.
you have like people that are a little bit more expertise. But anyway, my point being is, I think that same phenomenon is happening to the software sector, where like we're seeing the beginnings of it, where this AI stuff is having massive productivity.
Yeah.
And like you see the layoffs, right? Amazon cutting employees. And then here's, to put it in perspective, go to slide 46. This is the drawdown of IGV from a historical basis. You can see how drastic it's been.
Dude, it's
So,
happening.
I mean,
Like
there's
at the same
lots.
time,
Yeah.
this week we got labor so we got unit labor cost numbers and productivity numbers, and like 2 quarters in a row of negative unit labor costs and huge upside surprises in productivity. I was looking, like we haven't had 2 quarters in a row of such big surprises on both sides in a very long time. Maybe you can make the argument that's due to labor market weakness and just trying to get more bang for your buck from each employee. I think it's a bit of both. Like there is a lot of useful things you can do with AI now. I think a lot of people got one shotted by just how crappy it was 2 years ago or even a year ago versus what's going on right now. And actually, that brings up a little workshop I was working on this morning that I want to present. To your point about podcasters who now it's there's no cost for us to record, and now there's no cost for us to be TradFi analysts. So this is
You can't,
actually,
you can't replace that hair. You can't replace
yeah,
that.
this is
God-given talent.
generate. You can't AI that, buddy. Meta earnings came out this week, yesterday, and I been messing around with Claude in Excel, and I just asked it. I was like, "Hey, like, I'm interested to hear about the guidance that was associated with your CapEx, with their CapEx AI numbers. run a whole analysis and create some charts. And it did this in like 5 minutes. It was really, really impressive. So this is the first one that was interesting, looking at street consensus versus actual for AI capex. And the big surprise is, even though they had lofty expectations in terms of how much capex they're going to run, still came above board at like 135 billion over the next year, which is just insane numbers. And when you compare that, I think this is, I'm actually curious on your take on this in a second, Tyler, but buybacks are disappearing for Mag 7. Like, we've reached the maximum amount of free cash flow that they can reinvest, and now they're tapped out. But capex is still increasing meaningfully for all these AI data centers. So, like next year, Meta doesn't plan to do like any buybacks at all. It's all going into capex, and that's okay because they're unlevered. There's very little leverage, and there's a lot of runway, and there's a lot of hope for that revenue to trickle through into AI. But this is like a pretty big change to market structure. What's your read on that, Tyler? If we just see like suddenly no buybacks from Meta,
I think this is way bigger than we think it is.
Yeah.
Because, $1 trillion of buybacks per year plus that float was getting taken out of the market. And now you have, basically the opposite, where say they don't have good earnings, the rate of change goes down, people sell. Like, that's probably why we're seeing part of this rotation.
Exactly.
And if you're, the other more interesting thing to me is, to spend this amount of money, this technology must be existential to your business model. It's like,
Yeah.
and so I just saw a headline that said Amazon's going to invest 50 billion into OpenAI. And these numbers are just, they're staggering, to the point where it's like chasing the freaking ring from Lord of the Rings is what I think they're all doing. And I don't see, this is how blow off tops kind of
Yeah.
are made. In my opinion, in large cap tech, is we could see if AI turns out to be what it is, and they're spending ungodly amounts of money to do it, this might be the end of the giant large cap Mag 7 bubble.
Yeah, it's a make it or break it situation. Here's a couple other charts again that, like, Claude literally made all this for me in like 30 seconds off one prompt. It's insane. And it is, like, I double checked it. It's pretty good. This is how their funding sources are changing over the next year or so. So you can see most of it was just being funded from operating cash flow. They started to do some new debt issuance, but now it's like we're ripping new corporate bond issuance. We're doing, private credit financing. They had this like $27 billion private financing off balance sheet deal that they did for an AI data center. They're drawing down on their cash reserves. Like, this is just I can't say this enough. I know we've had these rants before on the show, but like, these Mag 7 darlings of just like free cash flow machines are not like that anymore. They're changing right now. And I think, yes, Meta's up 10% after, but that's because their earnings just surprised by the upside. But I think the forward guidance here for 2026 onward is just a very fundamental shift in their business models. And yeah, there's still demand so this is their bond issuance. Like, there's a lot of runway. This thing was 4 times oversubscribed. But again, their free cash flow margin is compressing. It's like they had a 30+% free cash flow margin, and now it's going down to nothing. And their long-term debt is just surging. Like, this is crazy.
The premium's going to get smushed, right?
Yeah.
And that's, I don't see what changes that in a world where, if AI works, like, God, it's kind of wacky to think about. Not only that, but I don't know if you notice this. I'm not even a big social media user, but when you think about the ramifications of like AI on social media, people are just going to turn it off. Like, if I know that person's not real, and you can kind of tell, in my opinion, maybe it gets better and better,
right
but
now,
like, there's like, I don't know if you'll see on Twitter, people respond to you now, and it's clearly some AI agent be like, "Hey, hit me back with a follow. I just followed you." It's all these, like, you can kind of tell if you're a human, if you're smart, but maybe that changes eventually. But I think that's the problem with all these platforms, is that AI can disrupt everybody. And I think everyone's going to just turn it off. I think that's the end game on all this social media nonsense.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. This episode is brought to you by Coinbase. If you're a long-term crypto holder but don't want to sell your Bitcoin or Ethereum, Coinbase now offers crypto-backed loans powered by Morpho. You can borrow up to $5 million using Bitcoin or $1 million using ETH as collateral, all at competitive rates, typically between 4 and 8%. There are no credit checks, loans originate in seconds, and you can repay anytime with no fixed deadlines. The USDC liquidity can be used for things like a down payment, refinancing high interest debt, unexpected expenses, or anything else life throws at you. Importantly, Coinbase does not treat borrow transactions as taxable events, and over $1 billion in loans have already been opened through the platform. If you want liquidity without selling your crypto, click the link in the show notes to learn more and get started today.
I do think there's a growing trend. There's actually these products called like basic phones or like dumb phones where it's like what phones used to be, and people are buying them. Or there's these actual devices where you lock your phone up and you can't get it out, and like people buy these things because it's so impossible to put your phone down. The thing this triggers in my mind is Felix Warren Pye's like work around why the S&P 500 is cheap or fair valued because of the composition of companies. And I put something out on Twitter and he responded. We were kind of talking about it, but my biggest maybe disagreement with that view is that, in the 70s, there's a point in the 70s or 80s where, the S&P was Mag 7 was oil companies. And you at that time could also say, well, the constituency mix is oil companies and the multiples are justified because there's a higher, but that constituency mix has always changed. And price to earnings multiples over many, many years through every single technological boom, railroads, internet, electricity, everything have reached a maximum because profits get competed away. And when you think about that constituency mix, these businesses are fundamentally changing from what they were. So saying that like the PE is cheap of a company, of a Meta that had no CapEx and 80% margins, operating margins, and was purely capital light tech business software is one PE multiple. But a company that has no free cash flow after capital expenditures and is a cap heavy, hard infrastructure business that's levered now is a different PE multiple. So
you can't look at the charts and be like, it's the same company. As the valuation is equally warranted.
Yeah. So you
go from a growth industry to just, you become a utility.
Yeah.
Yeah. So it's a completely different, and just by that metric, right? Like just fast forward this because they're all increasing these. So these numbers are only going to worsen, right? They're not improving from a cash flow perspective. So play that forward to 26 or 27. We're in 26, 27, 28. The multiple just on that fact alone becomes harder to justify at a market wide, Mag 7 wide 25 to 30 PE. And if you go to chart 39, I thought this was really interesting because everyone talks about like mags, the S&P versus the rest, but equal weight's also at all-time high multiples. And now Russell's recent move, it's at 2024 Trump election PE highs and book value, price to book highs. So nothing in the market that's cheap. Maybe some energy, maybe some, specific sectors. But if you look at the right, there's pretty much nothing in the equity world that's cheap.
To play contra to that, though, what happens if there is some like currency crisis with the dollar and this, like, you do get a Weimar Germany type money printing event or yield curve control? then
Well, we're seeing it with gold. That's what happens.
That's
Like,
why people are going for scarcity, because suddenly we've
Yeah.
realized all these software things, they're no longer scarce,
yeah.
whatever. So now everybody's reaching for something that they know is durable.
what happens is nominally earnings go up because inflation. In Weimar, you had crazy inflation, so earnings go up, but that doesn't change the price to earnings because if there's 10% inflation and earnings and there's no profit margin hit, earnings appreciate 10% a year just nominally. But that doesn't mean the multiple should go to the moon. Like the multiples never have done that.
Yeah, I would love to see a longer term chart going back 100 years, because I mean certain industries probably have premiums in that backdrop, and then they get egregious, and then certain get absolutely decimated. But I guess what I'm trying to say is, like, if debt loses value, the idea of like owning debt just goes, poof, because of political reasons. The only place you have left to put your money to save face is equities. That's like the
No, it's
only thing.
alternate currencies and stores of values or companies that produce them. Because
Yes.
in effect, gold miners are
You're saying the same
the
thing.
sovereign bank. Yeah, effectively,
Yeah.
gold miners are the sovereign.
I think the point here is, like, let's just look at what happened in 2022. In 2022, when we got the high inflation, everybody needed something that they could hold on to hedge. They went into Mag 7 because they're free cash flow machines, and it was basically like a hedge against inflation. And I think, like,
In
with
22,
how they came back pretty strong.
in 23 and 24, but tech got
23, yeah,
obliterated.
It did get obliterated at first, but then it came back pretty significantly once people realized that, okay, with rates where they are, I can hold on to this asset class that is just spinning off free cash flow, and then they came back ripping.
Mhm.
But I think that's not going to repeat itself because it doesn't have the free cash flow anymore.
Or buybacks.
Yeah, or
Yeah.
buybacks.
Yeah,
Yeah, it's
yeah.
a buyback free cash flow machine. Like, it was like, why would it? This was the new T-bills, like people were saying. It's like, I don't want to own debt. I'm going to go in Mag 7, and I don't think that's repeatable. So now we're seeing it in metals instead.
Well, the other fuel to throw on that fire is if the labor, the two big things. Oh, they're just buying back every last one of their stock with all their free cash flow, and all the passive flows are flowing into Mag 7. Well, the labor market has been shedding jobs for like 6 months straight now, or whatever it is. So is that now going to become a net, and we're seeing the savings rate dip, which means people are going into their, the disposable income more and saving less. So is that actually turning in terms of the passive flow boost to Mag 7? Because if buybacks and all the new passive flow from 401k contributions are actually both turning over at the same time, like, look out.
Yeah, that's a scary thought.
Yeah. I mean, I think all we're saying here is that, like, the fact that Nvidia has been chopping for 6 months is not a coincidence.
Yeah. It's a lot of distribution or accumulation, and we will find out over time.
On the market structure from a micro perspective, check out this. This is slide 44. Today we saw like an insane vol spike in the morning. I took this snapshot literally almost at the peak of where the VIX was, and the 9-day VIX was up 33%. If you look at implied correlation 1 month, that was up 77%. So these systematic guys, this is what's so messed up about the market structure is, like, I think SPYs closed, where'd they close? Down 20 bips today. But like, you have this, because of this homogeneous way these systematic quant investors, you could call them, I think they're more systematic investors, manage, there's insane intraday vol. But then we end up down 20 bips, and it feels like nothing really happened. But if you look under the surface, it was wild. And this stuff is happening more and more. And I think it's a sign to me. It's like, if you go to like an EKG, your heart's going boop, boop, normal. And now we're going boop, boop. And it's getting like, I feel like we're having a heart attack here, and no one's really like adding it up.
Dude, it's crazy. Like I was
This,
just looking at silver. It was down 20%, or sorry, 12% in one day today, and now it's closing at just down 80 basis points. Like it's just
yeah.
absurd.
This is, and finish your thought. And I have something. It's hilarious you bring this up.
Well, I think it's like they're across assets. We're trying to figure out a reality. If you look at, like you said, gold vol super high, but and then intraday equity vol super high, yet they keep stifling bond and FX fall. And so everything else is trying to find some sort of equilibrium around the world of what new system we're going to use for stores of value. And it's just I'm getting increasingly nervous. The only thing that hasn't
You should
blown
be.
out is credit spreads. Credit spreads are still low. Bond volatility is still low. And this is to the policymakers and, geopolitical trade, the Western world of trade has not been bothered by it yet. We haven't seen the carry trade unwind yet. I actually have Mike Guyad said he's going to come on. I've been talking to him on Twitter, and he's obviously super bearish, thinks we're going to crash. And me, I'm like, oh, this is Weimar Germany. We're going to just melt up and to infinity.
You two together is going to be incredible.
Because the funny part is, I
you guys
see
are
what
so
he's
different.
seeing.
Yeah, but like I could not think of two people more different in their views.
Yeah, and I actually respect it. Like I really like his
Yeah.
stuff, and I think he gets the macro. It's just that his end result is the world's ending, and mine is the governments will always bail it out with paper.
So here's a hypothesis. I was having a conversation with my buddy who's my credit plug. We used to work together, and he's at a big credit fund, and he was commenting on how the shittiest of all credits, triple C hooks, like are getting done, and any company with a pulse is getting through. And we were talking about his earnings seasons coming up and some of the different sectors he covers, and I was just remarking how there's so much idiosyncratic stuff going on. You have geopolitical risk in Iran and Venezuela. That's just anybody who has oil expertise is just locked into the energy space. You have AI with the potential CapEx boom issues coming to surface, hitting the Mag 7, hitting the hyperscalers, like these whole, problems that's requiring everybody's attention. The software side of AI, which is like, is it dead? Is it going to get crushed? Everyone's focused there. You have the small, like there's eyes and attention on every single part of the market because there's so much going on. I kind of think that, like Tyler, what you're explaining, to me, everyone's so locked in trying to figure out their sector that the macro here is kind of going unnoticed and in a sleepwalking way where like everything that's going on is not good for equities, in my opinion.
Yeah.
None of it. The little vol, like all these little vol spike teases that get hammered down, it's like they're VIX shorts are at highs most recent to middle of 2024 when we had vol. Like there's so many fact patterns here that are just terrible. I think most people are probably best off just leaving the markets for 3 months and keeping notification when you just get some big, thing happen in the assets you watch, because I do think I'm really negative. Like that doesn't mean, people think, oh, okay, he's 2000% max short right now. It's like, no, you have to be tactical with how you're playing it. And timing is huge, but I do think there's huge risk brewing that will come to the surface in 3 months. And that's a view you can have. Cash it. I know, we all hate fiat, but for short periods of time that, cash is a position, or SOFR futures. If in my case, I think that, that there's going to be more cuts than currently expected. So that's just my sentiment is like, I don't know what's going to be the crack. No one knows, but it's brewing. And my guess is in the next 3 months, there's some vol event.
I think I probably am in the same seat where the one thing that's so tricky to me is the credit spreads. And I know that usually comes at the end. And what I'm watching for everything to break is I think I remember this in 2008, which was when I was sitting there. I think gold rallied and then oil went on this super spike. It just blew out. And I think when oil blew out, that blew out the bond market. And then, everyone got worried. They got a little more hawkish. Credit spreads blew out. That could be the playbook if I was going to, put my finger on it. But I think before then, we get yield curve control, you get SPR release, you get all sorts of things government intervention wise to try to stop that, Armageddon, because this is worse. All the imbalances are 10 times worse than they were in 2008. Like the world is breaking apart clearly. Social contract unraveling. It's the worst of the worst, and they just it's like putting like your hole in the dike, and then another one leaks, and you're like going like this, and you're going like this, and all this is the boomer system's unraveling here. It's so fourth turning, and it's scary. I shouldn't like laugh about it, but the probability is that you could also have the equal outcome that AI comes to fruition. We have a productivity boom. This is a 21st century, industrial revolution. If they can keep the bond vol low, that's also a possibility.
But then what do you do if that productivity boom makes for mass white collar layoffs too? Like there's just,
yeah, it's crazy.
The credit spreads thing is over discussed now because credit spreads now are coincident indicators. They're not leading indicators because when you have when the leverage problems at the sovereign, it's not caused by credit. There's no credit issues in the economy because they paper over every crack. So all the corporates are fine. Like we just said, all of them have termed out all their debt. They have access to the capital markets because a lot of corporates are better credits than the underlying sovereign. So the credit spread thing is, if you just plot a chart of the S&P and credit spreads, it's coincident. It's not leading. So it's only that it seizes up after.
And a lot of the risk is off balance sheet now too in private credit markets. Like to my point earlier about Meta, like their $27 billion data center deal, that's off balance sheet in private credit. It's not being priced in public credit
spreads. Tyler, the sides you're seeing is the Friday night announcements from last week when BlackRock's like, oh, our one credit fund took a 20% haircut. It's like, oh, that's weird.
There's your credit spread blowout. Yeah, it's just off. It's not in public credit spreads.
Yeah, it's a weird world, man. I think, it's a weird world.
In some ways, I'm like really optimistic because some things are changing. Like I said this to my buddy this week, is like, I finally feel like even if there is a lot of pain here, that there is some green light for the next generations for the first time in a while. And I don't know if it's a weird, bizarre thing to have. I just think like when you see crazy moves in asset classes, like if you caught the gold move, like
that was sick.
That's finally like, you stay ahead of massive amounts of inflation if you have capital. The hard part is like if you don't have capital. That's true. Like where the social contract.
Yeah, that's the whole thing. Like I think the social unrest is going to get worse before it gets better. But I think if you keep your wits about you, you can see the light at the end of the tunnel. It's just it gets darker first.
I mean, just be an optimist at all times and approach everything in an observant mindset, and don't get married to views, and then you can profit from all the environments.
Yeah. I mean, I think just the point about how exciting thematic sectors are right now is important, and why, like, like last week people were like, oh man, they didn't mention Bitcoin or crypto once, and it's like, well, because it's a completely dead market right now, and there's just so much interesting stuff happening right now in so many different sectors, long and short. Like you can run a delta neutral book right now and short software and long metals, and like you had a sick month without taking delta exposure. And like there's a lot of different opportunities like that right now, and you can be negative, you can be bearish on beta on index and still have long, still have shorts. Like there's just a lot of fun action right now if you're a trader.
Yeah, it's a very nuanced market. Like I've been short big tech, and it's been zero, like flat, and then the metals and everything else has popped off. But I don't know what the next. I think my honest take is I think the next trade is it all down together, because correlations need to see some life, I think. But that could be in 2 months from now, and plenty of money, trading to be made before then.
I mean, today was dicey. Like you saw everything down. Metals down, equities down.
Well,
Like
it's hard to
dollars.
like.
Yeah, I don't know.
You have to be really cognizant of the environment you're in and where the money's been flowing, because historically, if you get a risk off day, right, gold has been rallying. But when you look at these charts of like silver trading as much volume as SPY, there's no way that's a safe haven in a deleveraging move anymore. So I think you just need to be cognizant, because the correlations you might have thought once were there, or the flights to safety, it's like you really in this environment need to be focusing on where people aren't, because I don't have it with me. I can show it next week, but the gross leverage levels across hedge funds, across all the prime desks, are at are like record highs. Net is like at the 2025 highs, because it net came down from it was much higher levels in 24 where people were running much longer, but gross just keeps scaling up. So you have hedge fund gross leverage at all-time highs. You have VIX shorts at all-time highs. You have, there's not really an asset class that people haven't piled into yet, right? Because you want to say, oh, Bitcoin and crypto are due, right? There's no positioning. There's no. It's all apathy now, which is great. But does that mean it's going to pop off? I don't know, because everything else has popped off already. And so you're kind of getting so long in this tooth, I think, of like these rotations before steam just comes out.
What's an interesting just thought experiment on that is like when Bitcoin really went on kind of a parabolic rise, there was less SPACs, there was less cool robotics or cool themes to chase, nuclear, AI infrastructure. It was just diluted by supply. First, you had the altcoins dilute it. That really ruined everything because, like, I mean, besides a handful of altcoins, I don't think they do anything. Like, generally speaking, like,
no,
I mean, they probably have a great idea, but
they don't
like,
do anything. You can just say it.
No, like I think Aave is a smart, like that. To me, that makes sense. It's like you lend, you get interest.
Yeah, but that's Aave the protocol. Aave the token has no association with it. That's the issue.
If you
also, Tyler, let's just level set too. MicroStrategy, the coin, the token, the equity, doesn't do anything either.
Yeah, well, yeah. I mean, that's fair. But that was an arbitrage. Like that was a public to private market arbitrage for however long period of time, and I think it was mismanaged on the supply of it and the ATM. And that caused like this boom in treasury companies that would oversupply the market. My point being is that they oversupplied the market with frontier ideas, and now the only thing to get the frontier ideas going to the next level is more M2 growth, more money printing, and you need a narrative, you need an access change. Like what would get Bitcoin moving is like a piece of legislation, or I don't know, some SoftBank saying they're going to go buy XYZ. But right now it moves from theme to theme, which is like space, and then that gets oversupplied because you do a bunch of space SPACs, and then that even hasn't even happened yet. But like when SpaceX comes to market, that all the other space stocks are going to get annihilated because everyone wants a piece of that thing. And my point being is that like now gold, you're starting to see all the Canadian brokers just, oh, that hole that was there for like 15 years, we got a great resource for you. It's just like the classic banker. They will dig up anything to serve you shit and put it on a platter. Excuse my French, but like that. That's
yeah.
what
I mean,
we're
to your
seeing.
point, like that's where like commodities are so mean reverting. Yeah, I think it's a really good point. Like, I mean, I've seen this now in people where for years crypto is the only game in town for degenerate speculation on frontier ideas, and now you have so many options, and some of the best like on-chain crypto traders I know, none of them are trading on crypto anymore because the game is rigged. You're either fighting a VC or insider knowledge or what have you, and you don't even know what you're trading. You're trading these altcoins with no claims on anything, whereas I can go into public markets and trade space stocks or metals or like all of these different sectors, and at least I know the game I'm playing, and that it actually has something real that I'm owning. So like, why wouldn't I do that?
Bitcoin will, like, people should we might be closer to we're approaching probably closer, in my opinion, to the price bottom than the top. I think that
I kind of agree with that too.
gold can front run these things because gold prospers in a shitstorm. And I think really to me, the most obvious thing that no one's talking about is, okay, there's the threats of Trump influencing the Fed, all, the scare and all the lack of independence. But you're telling me Bitcoin's not going to move when he actually gets the Fed to be cutting like Moran wants? You're telling me when he's got the board taken over and they're doing 25, 50, 75, 100 bips below neutral, you're telling me Bitcoin's just going to sit there like a limp dead animal?
Yeah.
No. Like, when that actually happens, on top of additional fiscal stimulus that's likely to come, that's 2021 environment all over again. Like, there is another day for it might not be led by DATs, but
I'm definitely not bearish Bitcoin here. It's either you have to wait for the upside game. So I mean, really, what you do is you either just buy some spot and don't look at it for 6 months, or you go try and tactically trade other markets. Like, it's one or the other. But tactically trading crypto right now is just like it's a pointless game, and it'll be exciting again, and then I'll be excited about it when it's time. But in the meantime, it's either you just like have your base allocation and wait, and go do other stuff.
Exactly. You want to be where be in the market that's treating your capital the best. But I do think these levels, when you just look at the last 3 years, it's really just the same drawdown. And if you bought these minus 33% drawdowns, you'd be printing at some point in the next 12. It's just everyone wants to be on like Forex leverage or long calls or like crazy decaying structures that like just make you poke your eyeballs out because you're bleeding so much decay.
Check this out. This makes me a little bit nervous. I just found this chart, slide 45. This is the 2-year break-even inflation, and I think it has a lot to do with oil. But like, what the Fed can't do is ease when you're getting a spike in inflation 2 years out. And I think they do watch these things quite. And this is probably why the first cut is supposed to come in like July. But for all of 2025, we've actually seen the 2-year break even go lower. And, it's very correlated with oil, obviously. But if oil breaks out here, I think that really puts a wrench in Fed easing plans. So you're probably going to end up with some sort of yield curve control to keep the lid on the bond market, is my guess. Is at that point, you get a super spike in oil, you got to just contain the bond market and just print ungodly amounts of money and try and get Saudi Arabia to pump and release the SPR. So that's probably what we're going to head into here in the next couple months.
This is my point, is like, when this happens right now, the market's it's more bark than bite. Everyone's like shitting their pants about Fed independence verbally, but the market would tell you very much otherwise. Long ends in control, SOFR futures, etc. My belief very strongly is there will be a time that they are easing monetary policy, whatever which way, into rising inflation expectations in the next 12 months.
Yeah.
And that is a point where
think about those rotations. Like,
it's 2021 all over again. It's when inflation was 7% and Powell went up there and said, we need to be cutting rate. We need to be doing QE.
And they're doing QE still. Yeah.
Yeah. Like, so this is coming back. Like, it's undoubtedly coming back at some point.
Well, I think that's a good spot to look at the last section of, there is actually Trump mentioned today that he's planning to nominate the Fed chair next week.
He said this like every week.
He says it every week, but theoretically, this is what's happening. Going to announce the head of the Fed next week. Anyway, last week we were talking about this too a little bit, and Andy Constant, good buddy of the show, replied to one of my tweets with this chart from his latest report. And I thought this was just a good way to contextualize what could happen here, because again, like we were talking about, if Powell stays on and then Cook, they can't fire her, with only 4 voting doves, and Powell and Cook both in place, the scenario will need clear data to support rate cuts more than priced. That's a tough sell for a lot of cuts. If only one of them stays, so say Powell decides to move on because of whatever happens, but Cook stays on, they'll still probably be able to. It'll be a bit easier to get the cuts that they want to get, but to really rip it and cut into higher inflation, and say the dollar is going lower because rest of the world economies are reaccelerating, like I think they're going to happen, lower dollar, and then you cut into that lower dollar. To really have the conviction to get the cuts that are more than what's priced in the market right now, you need both of them gone. You need to be able to fire Cook, and you need to be able to have Powell out of there. So I think it's going to be really important to keep an eye on this over the next couple weeks.
This is a great chart, and it's
Andy, man, the wizard.
We're going to get into that middle block. I think. I just don't. I think Powell wants to play this game, but there's so little reason why he should stay. Like, get the hell out of Dodge if you're him. And I just, they're going to get rates lower. They're going to get rates lower. I mean, they went as far as forcing a government shutdown and nearly fudging inflation data to attempt it. Like, they're going to do it. Like, it's going to happen.
It's wild times, man. We were all over the place today. A lot of stuff to think about. A lot of stuff to think about,
guys.
It's not without its bumps along the way. Like, there's going to be some crazy turbulence, but they're going to get rates lower.
Yeah. All right, gents. Another one done. Great as always. Have a good weekend.
Have a good weekend, boys. Stay warm.
Bruce.